Markets Upchuck, and today's post was titled Oracle, a Lesson on Valuation. And as I mentioned in the post, Oracle just recently reported earnings. I listened to their conference call, and it was quite optimistic and quite positive. The company just instituted a dividend for the first time. They had, a pretty solid year. If you think about their fiscal 2009 was, somewhat flattish, but yet quite strong if you consider everything going on in the economy and so on. And then they made some real positive comments. And the long and short of it is the stock ended up, at one time it was up over 9% intraday yesterday, and it ended up over 7% to 21.26. It's up again today. It's at around 21.5. And the point is, I just felt this was such a great opportunity to focus on what I call a lesson in valuation, because if you look at this company, they've had a 23+% average growth rate in earnings, over a long 20-year history here. They had a big surge in earnings growth during the irrational exuberant period, which caused their stock price to get ridiculously overpriced. And this is the real focal point of today's post. This was a case where Oracle was doing extremely well during this period, but the market was mispricing it to the tune where they had it overpriced at at its peak when it was trading in the mid-40s. The stock was actually only worth 10, and within a year to 2 years' time, the first year the stock corrected from 45 all the way down to 16, where it was still overpriced before it ultimately came back down to its, earnings single-digit justified value based on that time. And when you look at this chart, on more benign times, the price correlates very closely to the earnings growth. And for any period where the price got above earnings, you usually had a correction. Anytime you could buy the stock below earnings, it were great times to buy the stock. And that really, follows through in today. Now, what you have here, as I said in the post, is a mirror image. You had the stock market, dramatically undervaluing the stock. It fell from a high in the mid-20s. The actual high in 08 was 23.62, as this line only has monthly closing prices. But in between the months, the stock got as high as 23.62, and by, towards the February of 2009, it had dropped all the way to 13.80, which was, right around this time frame right here. Again, I only have monthly closing prices here, until it's subsequently now rallied back up to 22. But the point is, it was extremely undervalued here based on its historical norms, and what you have now is the stock simply moving back to a more realistic valuation. I still think there's room to run, but on the other hand, I also want to point out there's no possible way that Oracle's, stock value could have changed by 7 to 9% just yesterday alone. They had a good quarter. You have to understand that at some point, whether it was a day before yesterday, or even continuing today, as I believe, the stock was undervalued or the market was mispricing it. When you look at the long-term track record of this company, it correlates very strongly, as it always does, to its earnings growth. $100,000 over 20 years would have grown to $4 million. That's a 21% compounded rate of return compared to the S&P that only did 5.3% over that same 20-year period. If you look at the stock currently on a price-to-sales basis, it's trading at one of the lowest price-to-sales it's ever traded at. The company has, just made a major acquisition in buying the Sun Microsystems Java, which, gives them the Java product. As they talked in the conference call, I invite any of you to listen to it. It's quite exciting. A lot of things in the pipeline, a lot of opportunity for this company going forward. But the main point today is a tremendously undervalued stock that is all it's doing now is coming back to its valuation. And all it takes is a little bit of catalyst of some kind of news. Back in 1999, I do want you to notice that Oracle had a slight drop in earnings, happening, from 2000 during the last recession in 2001, which was the catalyst as earnings began to weaken and people began to realize that, which really caused the stock collapse. We've got the opposite catalyst now. We're forecasting a very strong 2010. They have a fiscal year. Their year ends on May of 09, so that's where their fiscal year 09. So fiscal year 2010 is May, 09 to into May of 2010. But I believe you've still got a company that's got very strong cash flows. It's a company that's very well positioned for the future. They've got some exciting new products. They've got new acquisitions to be made. As you can see, their operating cash flows are even significantly stronger than their earnings. And even if you look at them from a free cash flow standpoint, you also get a picture of a company that's a tremendous buy. Its free cash flows actually are higher than their operating earnings. So this is a terrific company. It's finally getting its due coming off of undervaluation. But the key point of today's post is, markets misprice companies. If you're only measuring performance without measuring valuation, as I always say, it's a job half done. I hope you enjoyed today's post and look forward to talking again tomorrow. It's Chuck Carnevale saying, till then.